Good morning. Thank you for joining Mayer Brown's Global Financial Markets teleconference series. Today's call is entitled Volcker Rule 2.1. Revisions bring greater clarity, certainty and opportunity for innovation. My name is Ed Parker and I'm a partner in Mayer Brown's London office and the Global Practice Head of the Derivatives and Structured Products Practice. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants. Should you wish to listen to the teleconference again or forward it to your colleagues, please do so. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not be having a Q&A session, please send your questions regarding today's topic by email to gfm@mayerbrown.com and we will respond promptly. That's the same email address, by the way, as on your invitation email. Our action-packed presentation today focuses on the easing of Volcker Rule restrictions, which allow banks to invest in certain covered funds. Drilling down a bit further into our presentation, we will be covering the relaxing of the criteria for foreign public funds that also benefit RICs and BDCs, the more permissive rules for parallel investments, new and revised exclusions that may spur innovation, such as for customer felicitation vehicles, more certainty for ownership interest definition and foreign excluded funds exemptions, and new exemptions to Super 23A restriction. And for that, I have three top-notch Mayer Brown experts to provide the insights. Pinedo, Matt Bisanz, and Marla Matusic. Anna is a partner in Mayer Brown's New York office and co-leader of the Global Capital Markets practice. She concentrates her practice on securities and derivatives, representing issuers, investment banks, financial intermediaries, and investors in financing transactions, including public offerings and private placements of equity and debt securities, as well as structured notes and other hybrid and structured products. Matt is a senior financial services regulator and enforcement associate in Mayer Brown's Washington, D.C. office. He counsels U.S. and non-U.S. financial services firms on a variety of regulatory and compliance matters, transactions, and investigations. And Marla is a corporate and securities associate in Mayer Brown's New York office. Marla advises clients on the structuring and trading of complex derivatives and structured financial products, focusing on bespoke structures designed for institutional and sophisticated investors, proprietary indices, and structured product automation. With those brief introductions, we will now begin today's discussion. First, I turn to Anna Pinedo to discuss foreign public fund exclusion, including RIC and BDC modification, and parallel investments. Anna, over to you.
Thanks so much, Ed. So, as Ed said, we're going to focus on the covered fund changes, other than the changes relating to loan securitizations. And first off, I'll talk a little bit about the changes to providing an exclusion for foreign public funds. So if we maybe take a step back and just think about the objective here, the agencies responsible for implementing and to have oversight over the Volcker Rule are really trying to achieve a bit of parity or consistency in the treatment of U.S. registered investment companies, or RICs, and a class of entity called foreign public funds. So a foreign public fund is a fund that's organized outside of the United States and that's authorized to offer and sell ownership interests in one or more public offerings. Now, that concept of public offering is meant to capture a distribution of securities that's made in a jurisdiction outside of the U.S. to investors, including retail investors, and the distribution has to meet certain criteria that are set out in the final rule. So the distribution has to be subject, just as a RIC offering in the United States would be subject to substantive disclosure and investor protection laws in the jurisdiction where it's being made. the distribution can't limit the availability to investors that have a certain minimum net worth or net assets. So it's really, again, intended to capture broad distributions, including distributions to retail. The fund issuer has to have filed with the regulatory authority in the jurisdiction where the offering's being made, and the disclosure documents for the fund offering have to be publicly available. So the final rule, as a result, as you can tell from what I just went over, eliminates the requirement that the fund's interests have to be sold predominantly through one or more public offerings outside of the United States. Instead, as I just explained, it really requires that the fund's interests be sold through at least one public offering, and that public offering be made in pursuant to local home country jurisdiction that is comparable to the kinds of requirements that we would have in the United States for an offering by a registered investment company. So related to this foreign public fund exclusion, the agencies also amended a provision that sets forth two conditions that, if satisfied, prevent a foreign public fund or a registered investment company or a business development company from being treated as a banking entity for purposes of calculating investment limits. The final rule clarifies that the 25% voting share limit in this particular provision applies to the banking entity and its affiliates in the aggregate, and the requirement that the banking entity provide advisory services or other services can be satisfied either by the banking entity or by its affiliates. So again, helpful for foreign public funds and a helpful clarification as well for U.S. entities. Last, before I turn it back to our other speakers, I just wanted to talk a little bit about parallel and co-investment transactions. So the rule clarifies that parallel and co-investments that are made by banking entities with covered funds are no longer included when you're calculating the permissible amount that's invested in a covered fund. Again, very helpful, and as we'll talk about a little bit more when Matt goes through 23A, certain transactions that are not deemed to raise any risk issues, for example, riskless principal transactions or short-term credit transactions, are also permissible. So, Ed, with that, I'm going to turn it back to you.
Thank you, Anna. Next, I turn to Marla to discuss new and revised exclusions, including for customer facilitation vehicles. Marla, over to you.
Thank you, Ed. The revisions have also relaxed the eligibility criteria for the loan security exclusion, including allowing a 5% bond bucket and expanding the definition of cash equivalent. These revisions were discussed in greater detail by our colleagues on a separate call. Several new exclusions will become available when the revisions become effective, including new exclusions for credit funds and for venture capital funds, subject to certain additional requirements and restrictions. These additional conditions include restrictions on proprietary trading as if the excluded fund were a banking entity, compliance with Super 23A restrictions, as well as additional disclosure requirements. Unexcluded credit funds will also be prohibited from issuing asset-backed securities. Safety and soundness standards that are substantially similar to those that would apply if a banking entity were engaged in activities directly will also apply to these credit and venture capital funds. There were several additional restrictions, including a cap on total annual revenue for excluded venture capital funds that were discussed in the prior proposal, but that were not adopted. No cap on total annual revenue is included in the final revision. A new exclusion will also apply for family wealth management vehicles, which is meant to allow more of the traditional banking and asset management services to be provided to these clients. To qualify, a family wealth management vehicle must either be structured as a trust, where all of the grantors are family customers, or, if not structured as a trust, the vehicle must be structured as an entity, where both a majority of the voting interests are held, directly or indirectly, by family customers and, other than a de minimis 0.5% interest, held solely by family customers and up to 5 closely related persons of those family customers. The de minimis 5% interest may be owned by a banking entity or its affiliates or by a third party, and is for the purposes of establishing corporate separateness and addressing bankruptcy and insolvency concerns. The revisions are meant to allow for broader client-focused service offerings, and accordingly, the family wealth management vehicle exemption is only available to banking entities where they are providing bona fide trust, fiduciary, or advisory, including investment advisory, commodity trading advisory, services to the family wealth management vehicle. Banking entities are not allowed to guarantee, either directly or indirectly, the performance of any family wealth management vehicle or to otherwise ensure any obligations of the family wealth management vehicle. Transactions between the banking entity and the family wealth management vehicle must also comply with Super 23B and the prudential backstop. The restrictions prohibiting the purchase of low-quality assets under Reg W will also apply between the banking entity and any family wealth management vehicle. The revisions have likewise added a new exclusion for customer facilitation vehicles that is also meant to allow for more of the traditional customer-facing banking and asset management services to be provided more generally. The definition of customer facilitation vehicle is broad and includes any issuer formed by or at the request of a customer of a banking entity for the purpose of providing such customer with exposure to a transaction, an investment strategy, or another service provided by the banking entity. For purposes of the exclusion, customer also includes the customer's affiliates and, importantly, a customer request is viewed broadly. It is not a reverse inquiry requirement. A banking entity can market its customer facilitation vehicle services, and a bank may have detailed and extensive discussions on the potential structure of a customer facilitation vehicle with customers, including any applicable affiliates, before any vehicle is created, including discussions related to the potential legal or accounting advantages, as well as any counterparty risk management benefits there may be. There are also no restrictions on the type of assets that may be included within a customer facilitation vehicle, giving banks and customers considerable flexibility. To qualify for the new exemption, all of the ownership interests in a customer facilitation vehicle must be held by the customer and its affiliates for whom the vehicle was created, other than a de minimis interest of 0.5% that may be separately owned by the bank or another third party for purposes of legal separateness or bankruptcy and insolvency concerns, just like in the family wealth management vehicle exclusion. The bank must also maintain documentation outlining how it intends to facilitate the customer's exposure to the applicable transaction, investment strategy, or other service. Like the family wealth management vehicle exclusion, customer facilitation vehicles are required to comply with certain additional requirements and restrictions, including the banking entities will not be allowed to guarantee, directly or indirectly, the performance of any customer facilitation vehicle or to otherwise ensure any obligation of the customer facilitation vehicle. The restrictions prohibiting the purchase of low-quality assets under Regulation W will also apply between the banking entity and any customer facilitation vehicle, and transactions between the banking entity and a customer facilitation vehicle must comply with Super 23A and the prudential backstop. The new exclusions will allow for much greater flexibility in the design and offering of new products and should allow for greater innovation. We also look forward to the return of some of the structured products, including certain types of funneling products, that were significantly impacted when the original Volcker Rule provisions took effect. I now hand things back over to you, Ed.
Marla, thank you very much. I finally turn to Matt Bisanz to discuss ownership interest definition, foreign excluded funds, and Super 23A. Matt, over to you.
Thank you, Ed. The revisions narrow the definition of ownership interest, which is a key threshold for determining when a banking entity's investment in a covered fund is subject to the Volcker Rule. The regulation has defined an ownership interest in a covered fund as any equity, partnership, or other similar interest. Another similar interest is further defined by reference to a broad list of characteristics, which arguably includes certain standard provisions in debt instruments. One such provision, the right to participate in the removal or replacement of a controlling party, such as a collateral manager, when no event of default or other acceleration of the debt exists, is a typical right for senior investors in debt. To address this issue, the agencies made a clarifying amendment to the definition of other similar interest and created an express safe harbor for certain senior loan and senior debt instruments. As contemplated in the proposal, the revisions modify the scope of the definition of ownership interest to allow for certain additional rights of creditors that are not triggered exclusively by an event of default or acceleration without such interest being deemed to be a Volcker Rule ownership interest. The revisions expressly permit a creditor to participate in the removal or replacement of an investment manager for cause. Although the revisions define in significant detail what events may constitute cause, we believe that the enumerated events are consistent with what the market generally considers and consequently should result in most senior debt exposures to CLOs and similar vehicles not being ownership interests subject to the Volcker Rule. The agencies also clarify in the preamble to the revisions that a debt interest in a covered fund would not be considered an ownership interest solely because the interest is entitled to receive an allocation of collections from the issuer's underlying financial assets in accordance with a contractual priority of payments. While this is consistent with the approach taken by the market since the Volcker Rule first took effect, this clarification should provide more certainty to industry participants that hold debt instruments issued by special purpose entities whose sole source of payment are their collections on their financial assets. Further, following from the proposal, which in turn reflected industry comments, the revisions create a safe harbor from the definition of ownership interest for any senior loan or other senior debt interest that meets certain of the characteristics included in the definition of other similar interest. Notwithstanding industry requests, the agencies declined to define senior for this purpose, which may limit the availability of the safe harbor in practice. However, in sum, the revisions are very helpful in easing the compliance burden for banks that make loans to and invest in certain debt securities. The revisions also address, as Anna mentioned, the long-standing banking entity issue by codifying an earlier policy statement to create new exemptions for qualifying for and excluded funds. However, these funds still remain subject to the Super 23A prohibition, which is what I will be discussing next and remains an area of interest. Turning to Super 23A more fully, the revisions address the prohibition against covered transactions with certain covered funds by authorizing banking entities to engage in covered transactions with a related covered fund that would be exempt from the collateral requirements, quantitative limits, and low-quality asset prohibition of Section 23A of the Federal Reserve Act as implemented in Regulation W. Such exempt transactions include making correspondent banking deposits, giving credit for uncollected items, and transactions secured by cash or U.S. government securities, among others. However, banking entities must comply with all of the elements of an exemption as set forth in Regulation W. This new requirement may prevent some banking entities from relying on certain exemptions, such as those that are premised on the covered fund being a securities affiliate of the banking entity. To address that final point, the revisions also permit a banking entity to provide short-term extensions of credit to and purchase assets from a related fund, subject to limitations that are similar to those that apply to the intraday extension of credit exemption in Regulation W. Further, in a change from the proposal, the revisions add a new exemption for riskless principal transactions that is similar to an exemption already in Regulation W, but that has been tailored to work in the context of the Volcker Rule. Overall, the revisions represent a meaningful step toward clarifying and rationalizing the Volcker Rule. The revisions include several changes that may provide opportunity for innovation with structured products, as well as some other changes that likely will bring greater certainty for banking entities. However, there remain several areas in which the Volcker Rule can be refined. For example, 2 SEC commissioners noted that the revisions do not exclude long-term investment vehicles from the definition of a covered fund, which has been an industry point for many years. An exclusion in this area could facilitate economic growth in these interesting times. We expect that industry will continue to engage on these issues, most likely after the U.S. federal elections later this year. Ed?
Matt, thank you very much. And thank you also to our audience for tuning in. A few brief reminders. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Lastly, as I mentioned before, if you have any questions related to today's content, then please email them to gfm@mayorbrown.com. Thank you again for your participation. You may all now disconnect.